If you are planning to retire abroad and believe that spending 182 days outside the UK keeps your pensions safe from HMRC, you are relying on a mathematical myth that could cost you tens of thousands of pounds. I'll admit, when I first started looking into expat tax planning years ago, I also thought the 183-day rule was an absolute shield. It felt logical: spend more than half the year outside the UK and HMRC leaves you alone. I was wrong, and learning how HMRC actually operates was a massive wake-up call. The 183-day rule is not how UK tax residency works. Under the Statutory Residence Test, HMRC looks at something far more granular and far more personal. It counts the ties you have to the UK, your family here, your property here, your financial history here. If you were a UK resident in any of the previous 3 tax years and you have 4 of those ties still active, HMRC can classify you as a UK resident even if you spent only 16 days in the country. Not 183, 16. That single number changes the entire calculation for anyone planning to retire abroad. But how exactly does HMRC find out where you are spending your time, especially if you stopped filing a tax return years ago? The answer is a silent digital data system that most retirees do not even know exists. HMRC runs a system called Connect. It was launched in 2008 and has been upgraded continuously since then. It is not a team of investigators making phone calls. It is an automated data matching platform that cross-references information from over 30 different databases simultaneously. The Land Registry, the DVLA, UK banks, and international financial institutions. And it runs quietly in the background, whether you have filed a tax return or not. Here is where it gets important for anyone planning to move abroad. In 2016, the UK began participating in the Common Reporting Standard, an international agreement coordinated by the OECD. Under that agreement, over 100 countries now automatically share financial account information with HMRC every single year. Bank balances, interest, dividends, investment accounts. This means that if you open a bank account in Spain, Portugal, France, or Australia, the financial data from that account flows back to HMRC annually. You do not have to tell them. The bank does it for you. Understanding how this system works is not about hiding from anyone. It is about knowing the rules well enough to make sure you are not unfairly pulled back into a tax system you have legally left. Because the trap is not complicated. It is actually quite simple. You leave the UK, you stop filing returns, you assume your physical absence is enough evidence that you have left. Months pass, a year passes, 2 years pass. Then Connect flags something. A UK bank account still receiving pension credits. A property still registered in your name at a Surrey address. Flight records showing repeated UK arrivals. Small things, each on their own unremarkable. But together, they build a picture that HMRC's system reads as, this person may still be a UK tax resident, and HMRC can reach back, not just for the current tax year, but potentially for every year since you left, with interest and with penalties. That is the residency trap, not a dramatic investigation, just the quiet accumulation of data you did not realize you were leaving behind. But the most dangerous part of this for retirees is not the data itself. It is a specific set of rules that working age expat guides almost never mention. Rules that apply differently to people who have family here, who have kept a property here, or who spent more than 90 days in the UK during their last few years of work. Those are the retiree-specific ties, and they are where most people get caught. Most of the guides you will find online about leaving the UK tax system are written for working age people, employees on assignment, remote workers, entrepreneurs relocating their business. The ties they talk about are employment ties, where your employer is based, where you perform your duties. For retirees, those ties are almost irrelevant. The ties that keep you connected to the UK tax system are different. They reflect the life you have actually built over 35 or 40 years, your family, your property, your spending habits across the year. These are what HMRC counts. The Statutory Residence Test sets out 4 ties that apply specifically to people who were previously UK residents. The first is the accommodation tie, having a place to live in the UK that is available to you for 91 consecutive days or more and spending at least one night there. If you are staying with a close relative rather than your own property, the threshold rises to 16 nights. But it still counts. The second is the family tie. A spouse, civil partner, or minor children who remain living in the UK as tax residents themselves. The third is the 90-day tie, having spent more than 90 days in the UK in either of the 2 previous tax years. This one catches a lot of retirees in their first year abroad because they often spent more than 90 days in the UK during the year they were winding down their working life. And the fourth is the country tie. The rule that if you spend more days in the UK than in any other single country, the UK counts as your primary country of residence for tax purposes. Now, the critical number. For someone who was a UK resident in at least one of the previous 3 tax years, here is how many ties trigger UK residency. If you have all 4 ties active, you become a UK resident after just 16 days. If you have 3 ties, the threshold is 45 days. 2 ties, 90 days. 1 tie, 120 days. 0 ties, 183 days. This is where the 183-day rule falls apart. If you have retired and kept any meaningful connection to the UK, you almost certainly have at least 2 ties. And once you have 2 ties, the limit drops to 90 days, not 183. I remember talking to a friend who kept his UK golf club membership and his local GP registration active just in case he needed a prescription when visiting his grandkids. He had no idea that HMRC could use those exact registrations as evidence of an available UK base and active personal ties to the country. He thought he was being sensible. He did not know it was creating a paper trail. Let me walk you through a scenario that plays out more often than most people realize. John and Linda are 61. They retire to Spain after years of working in the south of England. They keep their family home in Surrey. They decide to rent it out rather than sell because property prices are strong and it feels like a safety net. Over Christmas they fly back and spend 3 weeks staying with their adult daughter in Kent, and they keep their UK bank accounts open for their pension payments to land in. Now count the ties. They have an accommodation tie, their Surrey home is available, and they have indirect access through family. They have the 90-day tie from their last working year, when they spent time in the UK wrapping things up. And because they spent 3 weeks in the UK and then travelled around Europe for the rest of the year without staying more than 80 days in any single country, they also have the country tie. 3 ties. Under the SRT Sufficient Ties table, 3 ties means the threshold for UK residency is between 45 and 90 days. John and Linda spent 80 days in the UK that year. They believed they were non-resident. HMRC disagreed. The result was a retrospective tax demand covering their Spanish rental income and their UK private pensions, income they had assumed was taxed only in Spain. This is not a rare edge case. It is the default outcome for retirees who move abroad without a specific plan to sever these ties formally. For most of the 20th century, declaring your tax residency was largely a matter of self-reporting. HMRC trusted that you would tell them when you left, and trusted that foreign banks would not be sharing your account details. There was no mechanism for automatic cross-border data sharing. Tax planning across borders was difficult for the authorities to check, and some people took advantage of that. That world ended in 2016, when the UK began implementing the Common Reporting Standard. It did not happen overnight. It was the result of years of international negotiation coordinated by the OECD, following the political fallout from high-profile offshore tax avoidance cases. But when it arrived, it changed everything. Banks in over 100 countries became obligated to report account holders' financial data to the tax authority of their home country. No opt-out, no grace period. For anyone planning retirement abroad, this context matters for a reason that is easy to overlook. According to the Office for National Statistics, a 65-year-old man in the UK has an average remaining life expectancy of around 18.5 years. For a woman, it is 20.9 years. That is a long retirement. Over 20 years, every single tax year is a potential audit point. A residency decision you make in your first year abroad does not just affect that one filing. It sets the baseline that HMRC can audit at any point during the next 2 decades. Get it wrong in year one, and you carry that error forward, with interest accumulating on any unpaid tax the entire time. That is the long-term cost of a short-term assumption. And it is why the decisions made in the first 12 months after leaving the UK matter far more than most retirees realise. When it comes to leaving the UK tax system, there are really two paths. Most people fall onto the first one without choosing it. The Fragility path looks like this. You leave the UK, but you keep a few things active just in case. Your UK GP registration because the NHS feels like a safety net. A credit card registered to your sibling's address in Leeds because it is convenient. You count your UK days loosely, from memory, without a log. You tell yourself you will sort out the paperwork when things settle down. The years pass. This path is fragile because it never actually ends. You are never cleanly in or out. And if HMRC ever flags your file, because of a Connect data match, because of a land registry entry, because a bank reported an account, you have no clean documentation to defend yourself. You have guesses. You have good intentions. But HMRC does not score those. The resilience path requires more effort up front, but it has a defined endpoint, a point where you can say, with documentation, I left, I notified them properly, and here is the evidence. On the resilience path, you file Form P85 to formally notify HMRC you are leaving the UK. You complete Form SA109 alongside your self-assessment return to claim split-year treatment for the tax year you departed. You obtain a tax residence certificate from your new country. And you use Form DT Individual to ensure HMRC stops withholding UK income tax from your private pension payments. 4 forms, a filing of records. That is the distance between fragility and resilience. If you want to keep building your retirement on solid ground rather than assumptions, subscribe to the channel. We break down these HMRC rules every week in practical, plain English. Let me stress test this with a scenario that plays out in Spain, Portugal, and France every single year. A retiree takes a £25,000 tax-free lump sum from their UK pension and moves to Spain in July. They have been looking forward to this for years. The weather, the slower pace, the cost of living, they assume that because they have physically left the UK, they are no longer HMRC's concern. Now consider 2 versions of what happens next. The unprepared version, they do not file anything with HMRC before leaving, beyond cancelling their direct debits. They have not formally rented out their UK home. A family member uses it occasionally when they visit. Spain taxes residents on worldwide income using a calendar year. So, because they arrived in July and spent more than 183 days in Spain that year, Spain considers them tax resident and wants to tax that £25,000 lump sum. Meanwhile, HMRC has not been officially notified they left. Their UK home is still in their name and accessible, and their residency status is technically unresolved. Both countries have a claim. Both pursue it. The result is double taxation on the same income. The prepared version, the same retiree, but they file Form SA109 with their self-assessment return to claim split-year treatment for the year of departure, formally splitting their tax obligations between the UK and Spain at the point they left. They register their UK property under the non-resident landlord scheme using Form NRL1, so their rental income is handled correctly. They apply for a Spanish Certificado de Residencia Fiscal, a Spanish tax residence certificate, and submit it to HMRC alongside Form DT Individual. Under the UK-Spain double taxation treaty, UK private pensions are generally taxable only in the country where you are tax resident. Once you prove Spanish residency to HMRC with that certificate, HMRC stops taxing your pension. Spain taxes it instead, and at a rate that is often lower than the UK equivalent for pension income in that bracket. Same person, same income, same move. The difference is paperwork completed before the problem appeared. So how do you make sure you are on the prepared path? There is a specific protocol, a short checklist of steps that covers everything you need to make a clean legal break. Think of this as a 4-step protocol, not a comprehensive legal guide, but the core actions that cover the majority of situations for someone leaving the UK after a working life here. Step 1 is filing the right forms with HMRC. If you do not complete a self-assessment tax return, you file Form P85. It is called the Leaving the UK form, and it notifies HMRC formally that you are departing and helps calculate whether you are owed a tax refund for the year of departure. If you do file a self-assessment return, which most people receiving pension income or rental income will, you also need to include Form SA-109. That is the supplementary form for residency and split-year treatment. Completing it is how you legally establish the date your UK tax obligations ended. Step 2 is managing any UK property you are keeping. If you plan to rent out your UK home, you should register with the non-resident landlord scheme by filing Form NRL1. This allows your letting agent or your tenant directly, if you have no agent, to pay your rental income to you without deducting tax at source. You will still owe UK income tax on rental profits as a non-resident landlord, but you pay it through a self-assessment return rather than having it withheld automatically. This is not a way to avoid tax. It is a way to manage your cash flow and ensure you are taxed correctly rather than over-withheld. Step 3 is claiming double tax relief. Form DT Individual is the application you submit to HMRC to stop them withholding UK income tax from your private pension at source. Each country has its own version of this form, and you submit it with proof of tax residence in your new country, which is usually a certificate issued by the tax authority there. Once HMRC processes it, your pension payments arrive in full, and your new country of residence handles the taxation. Step 4 is maintaining an evidence log. This does not need to be elaborate. Keep your flight boarding passes, both physical and digital. Save utility bills in your new country, in your name, dated from the month of your arrival, and keep a simple spreadsheet tracking every day you spend in the UK during each tax year. The tax year runs from the 6th of April to the 5th of April, not the calendar year. Count every day you are physically present in the UK. Even partial days can count in some circumstances. 4 steps. Most of the actual work is done in the first 3 to 6 months after you leave. After that, it is maintenance. Updating your day count log each time you visit, and keeping your documentation organized. These steps are not complicated, but a surprising number of retirees put them off for months, sometimes years, and when I have asked people why, the answer is almost always the same. Most people who delay dealing with HMRC paperwork are not irresponsible. They are not trying to cheat anyone. They are avoiding something that feels overwhelming and sometimes even unfair. After paying tax in the UK for 35 or 40 years, income tax, national insurance, VAT on everything you bought, the idea of now having to prove to HMRC that you have left to formally justify your own departure feels invasive. It feels like the wrong direction. You paid in, now you want to step back, and instead of a clean goodbye, there is a stack of forms and deadlines. That feeling is completely understandable, and it causes a lot of people to do nothing. They leave the forms for later. They avoid opening letters from HMRC. They tell themselves they will sort it out when things settle down in the new country. This pattern has a name in behavioral economics, the Ostrich effect. It is the tendency to avoid engaging with financial or administrative problems because engaging with them feels worse than not knowing. The trouble is, the longer you wait, the more complex the situation becomes. HMRC does not stop generating data on you because you stopped opening your post. So, if this is where you are, somewhere between meaning to sort it out and actually doing it, the advice is not to tackle everything at once. That is exactly the kind of task that stays undone. Start with one thing. Download your flight history for the last tax year. Most airlines let you do this through your account settings. Put the dates in a spreadsheet with a column for days in the UK. That takes 20 minutes. That single action breaks the cycle. You have started, and starting is the hardest part. I don't know every detail of your personal financial setup, and tax rules can change. But I do know that taking control of your paperwork is one of the most effective things you can do for your peace of mind in retirement. Not because HMRC is waiting to catch you, but because having the documentation means you never have to worry about whether they might. If this breakdown has been useful, please subscribe to the channel. It is how we are able to keep making independent, plain English financial guides for people in exactly this situation. HMRC does not rely on your self-reporting to track where you live. It runs automated data systems that cross-reference your financial life across multiple countries. For retirees, the ties that matter are not employment ties. They are family, property, your spending pattern across the year. Understand those ties. File the right forms when you leave. Keep a simple record of your UK days. That is genuinely all it takes to make a clean, legal break and to protect the retirement you have spent decades building. Thank you for watching Arthur's UK Retirement Guide. Subscribe for more practical retirement planning, and I will see you in the next video.